Property investment is known as one of the best and safest investments in the world. And in this video, I'm going to break down how to mitigate those risks so you keep more money in your pocket. However, big rewards do come with big risks. So the first thing you want to be looking at is market fluctuations. This is going to come in the form of your occupancy rates, your interest rates, and inflation. And you really need to be measuring these three things fairly regularly. So let me just go through them. Occupancy rates is the long-term occupancy rates in your area. There's over 200,000 properties in the UK that are empty over the long term, which is crazy, but it's definitely an important stat because it gives you an idea of supply versus demand, and it should give you an idea of how active the local government is, the local council, to get properties habitable and lived in as soon as possible. Inflation, you should already know this, but inflation is basically the erosion of your money. So if you've got a pound today or a pound in a year, what would you prefer? A pound today, because in a year it's worth a lot less. And essentially, it doesn't mean like people go, a pound is a pound is a pound. Yes, but essentially inflation means it costs you more. So if you think of the famous Freddo bar, I heard of the day where they were 5 pence. I don't remember that. I remember 10 pence Freddo bars. I was on a plane a couple of days ago, got back to the airport, which is probably more expensive than most, and a Freddo was £1.40. What? But that's inflation. So even in a normal store, it might be, I don't know, 50 pence, for example. But that is inflation at play. And finally, interest rates. Inflation is like the accelerator. Interest rates is the brake in a car. Don't know why I'm doing it that way around. It's the other way around, I know. So interest rates are a deliberate mechanism that the Bank of England comes into to put a brake on the economy. It's a good move when we go too fast. Very much like growth or speed in a car. It's fun, it's brilliant until you get out of control. And that's what's happened in the last couple of years. So the Bank of England applies the brake, and that's good. So why are these important? Well, because you can predict the future with it. So if interest rates go up, it means two things. The market is going to go flatter instead of growing aggressively. And it also means opportunity. In general, if in doubt, zoom out. And what that means in property is you're making 20, 30, 40-year investments. So if you're investing in property, it means you believe in the long term. And so why would you let short-term struggles dictate you not buying? I know this is a bit counterintuitive, but when the interest rates go up, I see that as a buying signal, because when interest rates go up, everyone else seems to struggle, everyone gets scared, the newspapers go, oh my God, this is going to happen, that's going to happen, that's going to happen. That means there's less competition. I then go and buy. What do you think then happens? Inflation comes down, interest rate follows and come down. What do you then think happens to the demand for property? It surges and it goes up. So follow those three metrics and you won't go wrong. By the way, I'm just going to say it now. If you've been watching for a while and you're thinking, do you know what, now's the time to invest in myself, we are actually opening up some spots on our upcoming cohort. So if you're ready to back yourself and you want to have a one-to-one consultation session with myself or one of my team, just put education in the comments and we can have a chat. The next thing to be thinking about is property management. So I've been on loads of property education courses myself. I've invested hundreds of thousands of pounds. Genuinely, as a team, it's almost $500,000 now. What? So hundreds of thousands, and they all teach you fairly similar things: marketing, mindset, and what makes a good property. Now, personally, I don't think that's enough as a property course. What about closing people? What about... Anyway, we're not going into that. I'll go into a rant. But I've gone on those courses. But what they don't teach you is when you actually own the property, where do you think the complexities come into property? It's not really buying property, selling a property, analyzing a property. You can watch my videos on how to do that. It's when you own the property. There's over 100 pieces of regulation to owning a buy-to-let property. So your EICRs, your CP12s, your right-to-let guides, your EPCs, your tenant rights, your Section 21, Section 8 notices, and loads more. So my opinion is, are you a landlord or are you an investor? And I know they're fairly interchangeable, but what I mean is, A landlord, in my definition, is somebody that is meeting their tenants, going and doing all these things. And it's like, yeah, that's great. That's nice when you've got 1 or 2 properties. Is that scalable? No. Instead, you should be an investor. I am putting money into this investment that's going to grow over the long term, and I want somebody else to manage my portfolio. In the same way, if I buy stocks and shares, I'll go on my app, I use Hargreaves Lansdown, and I will buy my shares through that. I don't go and try and negotiate the shares and become a stockbroker. In the same way, when you own property, outsource it to a reputable management agent. Now, for me, I want to know that they've got a good background and experience. How long have they been managing properties? Check out their Trustpilot. Of course, every company is going to have 1-star reviews, but what do they say? What are the 5-star reviews? What are the common things that are said? Make sure you've got great management in place. I promise you, I know so many people that go, oh, it's a waste of money. They barely do anything. They manage my property, rent it for 700 quid, and they get paid 70 quid. I swear they make more profit than me. It's like, I promise you, price is what you pay, value is what you get. And if you're somebody that focuses on price, you are in a losing game. Focus on the value and you will make more money in the long term. Next is liquidity. What does that mean? Well, you need the fucking money. When you are investing in property, they are big lumps. It's not like 20 quid that you found on the street when you walk in there, you go buy a house now. That doesn't happen very often, does it? But when you're buying property, we're talking 50, 60 grand in terms of your deposit, your fees, your refurb, your legals, your stamp duty, your broker, everything that goes into purchasing a property. And then what happens is, if you have liquidity concerns as an individual, like, I'm short this month, or the car's broke down and I need to pay for a new X and it's going to cost me £1,000, but I don't have that money, you can't just exit property quickly. And again, I mentioned I use Hargreaves Lansdown to my stocks and shares. So again, if I go on here, which, what's the point doing it now? I'll go on there. If I need 5 grand, 10 grand, and I need it quickly, and for some reason I don't have any cash in my bank right now, then I will be able to go on there and quickly release that £10,000 in a matter of minutes and have it in my bank account within a couple of hours. And so when you are investing in property, it's really important to hold back some of your money. So again, you need to be smart about this, because if you've managed to save up a decent amount of money, then maybe you'll be able to save more. However, if you're raising money elsewhere, and a key part of growing your portfolio is joint venturing with other people where they fund your deals, make sure you've got enough cash as an individual for little pieces of buffer. And the reason for that is, let's say they put in 65 grand, but something happens where there's some damage to the property that then you need to pay for, but you don't have the money. Therefore, somebody's not renting the property, therefore you're not getting any income, you're paying out the mortgage, the council tax, the bills. It can slowly or very quickly spiral. So make sure you've got your liquidity correct. The final one is regulation risk. What a real fun topic to talk about. Not really. So regulation, let's face it, is boring, is a bit shit, but it is something that comes into play. So in property, I think in some ways there's a lot of regulation and there's not. So for example, we don't have loads of regulation around raising funds. So you get your debt portion from a bank or a mortgage lender, which is fine. And then on the equity side, you can get loans or joint ventures. You just need to make sure they're a sophisticated or high net worth individual. Not that complex in the grand scheme of things. But when it actually comes to owning the property and the macro environment, there's a lot of regulation around that. What the fuck does macro environment mean, Jamie? Well, the government just seems to fuck us left, right and centre, right? So do they like landlords? Yes, but they also need to get voted in. And so when people are struggling as renters, who is the most natural person to blame? The landlords. It's all because of them. Obviously, there's not many tenants that are struggling and then have a positive outlook and go, hey, isn't it pretty cool that I'm getting provided a house by somebody else, that they bought it and I only have to pay pennies on the pound on a monthly basis for this? Not many people have that mindset. So the government makes all these changes. So a really big one, for example, is Section 24, which was in 2018. Look that up yourself though, I might be slightly wrong there. And what happens is everyone or pretty much everyone owned properties in their personal name because it was the most tax effective because you could write off. And in Section 24, literally overnight, this just came in and just went, by the way, you know your interest that you pay on a mortgage now? Yeah, that's not a legitimate business expense. Oh, by the way, if you own it in a company, it is a legitimate business expense. It's like, what the fuck? That makes no sense, right? So what people will now do is they buy property in a limited company, and a lot of people are moving those properties over so that they're a lot more protected from any government regulation. But there's new regulation all the time. The most recent one, at the time of filming this, is the Renters Reform Act coming into play in 2024. But we'll see about that one too. But regulation is definitely not the sexy side of property. It's not the reason people watch these videos. They want to learn about money and everything else. But I'm telling you, if you really love money, you're going to learn how not to lose it. So, I mentioned it earlier, if you're ready to back yourself and invest in yourself, I know regulation's not the most sexy thing in the world, but I promise you, if you genuinely want to build a six-figure income in property over the next 12 months, I don't care if you're at the beginning of your journey, in the middle, maybe you've gone on some courses but haven't been taught the correct stuff, then I want to open this invitation to you. We're opening up a new cohort. We do it as an intake. It's a blended learning program, but if you want to have a one-to-one consultation session with myself or one of my team, put education in the comments and we'll have a chat. No obligation, and we'll see where we go from there. If you're new to the channel, by the way, and you want to learn more about making money, mindset, business, specifically in property, make sure to hit that subscribe button and the notification bell to make sure you're not missing out on upcoming videos. And if you did get value, make sure you tap that like button, and I'll see you in the next video.